Hey everybody, thanks for joining us. This is the first Andrew and Tyler show of the year, which I think that's the name we're going with. I think we're just gonna stick with it. We got a good one for you. I think this is gonna have a lot of good information for everybody. Um, Before we get started, typically, if you ever joined us before, what we do is we pretty much, as questions come up, we'll try and get them answered. Because of all the info that we were going to have for you today, as the questions come up, throw them in the chat window there. And at the very end, what we'll do is a Q&A for everybody, and we'll make sure we get everyone's questions answered. But I'll turn it over to Andrew and let him take it away.
Tyler, thank you. Thank you all for joining us today. I think we've got a really uh, timely and interesting presentation today. Our presenter is Strider Ellis, and Strider is a senior economist and part of the First Trust economics team that Bloomberg has consistently ranked as one of the top forecasters of the U.S. economy over the past decade plus. And at First Trust, Strider is responsible for analyzing economic indicators, writing economic commentaries, and building content. And when I think about a time to get an economic update, I think with all the volatility of this year, and it's hard to believe it's only been 2 months, uh, I think there's no better time to kind of see what the data says versus what all the headlines and noise say. So, with all of that, Strider, please take it away. And thank you so much for doing this.
Yeah, thank you, Andrew. Great to be with you and Tyler and all of your clients. There's obviously a lot going on in the economy, and we'll try and get through as much as we can in the short time that we have together. But I think really when you look at the economy today, there's two real views on where things are headed. You have those in the administration that believe we're going to see 5+% real GDP growth, or the economy grow by over 5% this year, or on the other side, you look at employment data and some other data that's been slowing quite considerably. In fact, at many times it looks like, from people's point of views, that we're heading towards a recession. And so you have almost this dichotomy where there's those that believe things are booming, and then those that believe that things are right around headed towards a recession. And I think really we're somewhere in the middle of that. We're not going to be booming this year. We're not headed for a recession, but it's slow, steady growth, probably somewhere around 2 to 2.5%, which is not bad. It's not great. It's not terrible. It's just not bad. And when you take a look at employment, it is true we have been seeing employment slow down quite considerably. It's still growing, but barely growing. In fact, Friday we'll get the employment report for February, and that's probably going to show somewhere between 30 or 40,000 jobs added to the economy, which is, again, very slow relative to what we have seen. But I think what's even more concerning is when you take a look over the last couple of years, it's not just that jobs are slowing today, it's that really the type of jobs that have been created over the last couple of years, it's been very, very narrow. Most industries have not been adding jobs, and the job growth that we've seen has come from just a couple different industries. And I want to look back over a couple different periods here to kind of give you an idea of where things are. And really, when you look at what jobs have been created recently, it's mostly fallen in three areas: leisure and hospitality, education and health services, and government. I want to focus on these especially because those last two categories, education, health services, and government, both of those are really driven by government spending. And you can see from 2015 through 2019, we'll give that as our base scenario of how jobs are usually grown over time. You see about half of jobs are everything outside of these three industries. The next period I want to look at is from May 2020 to December 2022. Reason being that was the period right out of the recession that we went through, that very, very sharp, steep recession during the shutdowns. And again, you can see pretty consistent. 54% was everything else. Look at how large leisure and hospitality was. A big reason for that was because it was hit so dramatically during those shutdowns. But What's been concerning to us is when you look over the last 3+ years now of where job growth has been coming from, you can actually see that almost, well, all of it has come from these three areas, but almost all of it's just come from education and health services and government spending, or excuse me, and government jobs, which both are really driven by government spending. Everything outside of these three industries has actually been contracting. And so to us, that's problematic. In fact, if you look just over the last year where jobs have been coming from, that orange bar is overall. We added about 360,000 jobs last year or through January here. And you can see that private education health services made up almost double the amount that we saw just from total non-farm. And there's been a lot of areas that have been contracting. And so from an employment perspective, things don't look that great. And a lot of people would say, well, this is all due to AI. We're moving into this new era where AI is going to be taking jobs. We're never going to see job creation again. And I don't buy into that. Anytime that we have seen a technology come on in the past, it's actually caused more jobs, not less jobs. Yes, there can be periods of indigestion, definitely, and some will lose their jobs. But on net, I think we'll see more jobs created than lost as we move forward. But when I would sum up the job market today, I think you can really do it by looking at what's going on with private office construction. Now you can see for the last 5 years, private office construction's basically flatlined. And what makes up the majority of private office construction is general office buildings. Those are buildings that are being built to house employees mostly. And that used to make up all of private office construction, or the majority of it. And you can see over the last couple of years, it's declined considerably. Well, what's making up the difference to at least allow private office construction to stay flat? And it has everything to do with data centers. And data centers have been skyrocketing. And so for me, I think this is what's going on in employment today. I think this chart sums it up perfectly. We are freezing hiring or letting some people go and hiring fewer people because AI is able to do more and more of these tasks that people used to be able to do, or entry level people were coming in to do. And so data centers are skyrocketing. Space for employees is coming down because it's not maybe as needed as it was before. But again, does that mean that the employment picture is coming to an end? I don't believe so. In fact, I think this is actually unbelievably encouraging what's going on with AI today. Think about how it lets you use creativity like never before. If you have an idea today, it has literally never been easier than any time in history to start a company than it is today, and less costly to start a company than it is today. I mean, think 15 years ago, if you wanted to start a retail company, a clothing company, and you wanted to sell online, I mean, it would cost you hundreds of thousands of dollars to build a really nice website to be able to sell online and have the whole back end done for you. Then you'd have to hire somebody just to manage that because you wouldn't know how to do it yourself. That's not what you were trained in. Then you'd have to hire attorneys. You'd have to figure out where I could sell, where I can't sell. You need an accountant, all these different things. Well, today with AI, with these large language models, you can basically do all of that for almost free. It's incredible. It works as a consultant for you. But on top of that, you can go to a website like Shopify and build a beautifully done website, completely custom, for $39 a month. And they have the whole back end that they'll do for you. So today, we live in an idea economy, and we live in a country that's extremely entrepreneurial. And if you have an idea today, instead of taking that idea now to your company where you might not have equity, I think what we're going to start to see is more and more people shift towards creating their own brands, their own companies, which might not hire as many people as a large company would, but it's still going to hire individuals. And those companies are going to be unbelievably productive. And we're going to move more and more towards this ownership economy where more and more people own what they're working for instead of working for somebody else. And to me, I think that's going to be a massive benefit to the US and really to the world over the next 10, 15, 20 plus years. But looking at the economy today, looking at households today, I'd say things still look to be good. Household debt sitting at record highs, very true. But just knowing the level of household debt doesn't tell us too much. We need to compare it to something else. And usually when households are taking out debt, they're taking out debt to purchase assets. And so a more effective measure I'd say to look at is household debt relative to household assets. And when you look at debt relative to assets, it shows you a pretty different picture. You can see 2000 moving on, debt relative to assets was growing and growing quite considerably. In fact, it peaked during the financial crisis. But I'd argue that you look at where we are today, although household debts at record highs, assets over the last 15 years have grown so much quicker than overall household debt, that debt relative to assets is actually sitting at some of the lowest shares that we have seen since the 1960s. But even more interesting to me is, what is household debt actually made up of? And about 70% of household debt is just sitting in mortgages. I look at that today as a massive benefit, because back in 2006, 2007, it was not a benefit at all. In fact, it was a detriment. We had the housing collapse, and a big part of that was because so much of household debt was in mortgages. But it wasn't just the fact that it was in mortgages, it was the fact that so many of those mortgages were adjustable rate mortgages. About 40% of those loans back then were adjustable rates. So as interest rates rose, people got into trouble that they didn't put very much down on these homes. They just let them go. We had the housing collapse. But you look at today, and I'd say 70% in mortgages is a massive benefit to households today, because when you look at what they're actually, the interest rates on these mortgages are, they're very, very low. In fact, we have over 50% of mortgages outstanding today that are fixed at less than 4%. Pretty amazing to think about. And so a lot of people have scratched their heads, well, why haven't we seen home prices collapse? Because demand's fallen off a cliff with higher interest rates. The reality is that there's just not so much supply on the market. It's all about supply and demand. Supply has been very low. Demand's been pretty low. And so it's pretty much in balance. And I don't really see that changing too much in the coming years, meaning that I think we will continue to see very small home price increases in the coming years across the United States. But you take a look at home prices, they've gone up over 50% over the last 5 years. It's not just housing, it's everything that's seen appreciation. If you've had assets, you've done exceptionally well. If you haven't, you've been absolutely crushed because of the higher inflation that we have seen. And so many believe that why we've seen this inflation is due to massive government spending. You look at this blue line here, that's federal spending. Yes, it's very true. There is high correlation. Government spending went through the roof and we saw massive inflation. Definitely correlation, but was it causation? And I would argue that just government spending alone is not what causes inflation. You look back to the financial crisis we went through in 08, 09, the massive stimulus that was put into the system over that period too. And yet we didn't see any inflation. So why was that period different from this? And the reality is what happened in 2020 and 2021, the reason we saw the inflation is instead because the only way government can borrow money is by either borrowing it or taxing it, or spend money is by either borrowing it or taxing it. They usually do this from the private sector. And when they do it from the private sector, it's not really inflationary because that's just money that's moving around that's already out there in the economy. What was so different in 2020 and 2021 is instead of the government borrowing that money from the private sector, they decided to borrow that money from the Federal Reserve. So the Federal Reserve created trillions of dollars of brand new money out of thin air and purchased from the Treasury Department trillions of dollars worth of bonds. So now the Federal Reserve has all these bonds, the Treasury has all this brand new created cash. And what did the Treasury do? They took that cash and directly deposited it into people's bank accounts with stimulus payments. So all of a sudden we saw trillions of brand new dollars enter the money supply in the United States. Here's a look for you at that measure of money supply. So this is all money that's outstanding in the United States. And you see from 1995 to about 2020, that money supply was growing right around 6%. And then all of a sudden it started to spike. And in 2020 and 2021, we saw money supply grow more than 40% over that 2-year period. Never before have we seen money supply grow that quickly in such a short period of time. And the second that measure kicked up was when we started to get very concerned about inflation in the United States, because as Milton Friedman always taught, inflation is just too much money chasing too few goods and services. If you grow the money supply by 40%, but you don't grow goods and services production by about 40%, you're going to have more goods or more money per good or service. And that's the inflation that we have seen. So what does it mean moving forward here? Well, as you can see, money supply actually contracted for a couple of years. And with that, inflation peaked at 9% and then started to come down. It's now growing again, but it's growing at about a 4.5% year over year rate right now, slower than the 6% we've seen historically. And so we believe that means further downward pressure on inflation is coming. Will we get down to 2% growth in prices this year? I'm not too convinced of that, but I think it will be, inflation will be lower a year from now than where it is today. But that doesn't mean government spending is not important. Obviously it is. And the problem is that we're spending around $7.5 trillion for 2026. And we're only bringing in a little over $5 billion, which means that leaves us with almost a $1.9 trillion deficit. So how do we fix this? Well, many people look at this chart and they say, well, it seems pretty easy. Why don't we just raise revenues another $1.9 trillion, tax the rich more? But the reality is it doesn't matter what you tax people at. We've seen marginal rates up in the 90s. We've seen them in the 30s, all across the board. And the reality is that if you look at that orange line there, that's revenues as a share of GDP, as a share of the economy going to the government. And you can see that they've averaged about 17.2% since 1950, sometimes a little above, sometimes a little below, but never anything too dramatically off of that. Now, the problem is why we always have a deficit is that we've averaged 20% of GDP for government spending. And so what's more concerning to me is if you look over the last 15 years, very rarely have we seen government spending anywhere close to even the 20% that it's averaged. And so when you look today, well, what's the issue? Well, revenues are sitting at their historic average. It's government spending that's 24% of GDP today. So the reality is if we ever want to fix this situation that we have fiscally, it's not coming from the revenue side. It's going to have to come from the spending side. And that means wading into mandatory programs, which makes up majority of spending. That doesn't mean cutting benefits. It just means starting with making them way more efficient. Get rid of the waste, fraud, and abuse that's so abundant. And that's going to take Congress. I wouldn't hold my breath that they're going to do anything anytime soon. But something eventually does need to be done. And that's the side that it really will need to be done on. But whether you like President Trump or not, I think one of the great things about him is that he loves to try new ideas. Some of those ideas I think are great. Some of those ideas I think are terrible. But I love the fact that they're trying so many new ideas. And one of those ideas is through tariffs. Now, he used tariffs the first time he was president as a tool to actually lower tariffs across the board for other countries. This time around, he started that way, but very quickly he realized, well, we need more revenue, so let's just raise tariffs and start charging, and we'll bring in more revenue that way. And sure enough, that's what he started to do, and you can see the effective tariff rates on goods coming into the United States skyrocketed. The very far right there, you can see all partners. The effective rate was 2.3% in 2024. In 2025, it's moved up to 9.4%. So pretty substantial increase there. But look at the individual countries. These are our top 10 biggest trading partners. Look at China, gone from 11% up to 31%, meaning if you import $1 worth of goods from China, it was costing you $1.11 to get them in. Now it's costing you $1.31. Now, the good news is the recent rulings that we've had on the IEEPA tariffs last week, or was it 2 weeks ago now? I guess it was just last Friday. I can't keep it straight. It was either last Friday or the Friday before. But either way, the ruling that we had on that basically said that these extra tariffs were unconstitutional. Now, the administration's put new tariffs in. They're called Section 122 tariffs, and they put a flat 10% across the board. But the reality is that this can only last for 150 days before they go away. And so there'll be other tariffs that they figure out ways to implement. But I think tariffs will actually be lower. The effective rates will actually be lower than where they are today. In fact, if you look in China with the new tariffs put on, it's gone from 31% down to about 20%. And across all of our top trading partners, they have lower tariffs today than where they were 2 weeks ago. So to me, that's a benefit. Reason being is because when we hear that, especially from the administration, that no, it's these countries that are paying the tariffs, it's just not accurate. The reality is that it falls on U.S. producers that are importing these goods, or it falls on U.S. consumers that are consuming them if the producers decide to pass on that cost. And so it is a tax, and it is a tax on U.S. citizens and U.S. producers. But it has raised a fair amount of new revenue. You can see in 2025, we raised about $280 billion through these tariffs. Now, what does that mean for 2026? Well, we started off on a lot stronger start because those tariffs in 2025, the new ones, didn't really kick in until April or May. This time around, though, I think we will see lower tariffs because we've removed some of them, but still it's going to bring in, I think, around $300 billion for this year as well in 2026. And so does that mean that the next president is going to remove these tariffs? I don't believe so, no matter if it's Democrat or Republican. With having new revenue come in, what that encourages them to do is actually spend more, not keep spending flat or lower spending to try and get things in order. And so no president in the future, I think, will cut these. So I think higher tariffs are here to stay for the long term. But again, it's not enough to take the economy into a recession on its own. And I think there's enough positive things that we've seen from the One Big Beautiful Bill, for instance, that are boosting the economy on net over what's happening with tariffs. So net, I think things still look to be pretty good. But when you look at what's going on with the stock market relative to the economy, they're two completely different things. And I think, yes, the economy is on solid footing. We'll grow 2 to 2.5% this year. But looking at the stock market, and when I refer to the stock market, I'm thinking about the S&P 500, which is what we call market cap weighted. So the largest companies have the largest amount of weighting in that overall index. And what we have seen is that those large companies have done exceptionally well over the last couple of years and have really driven the gains for the overall stock market or the overall S&P 500. And so many people have been overweighting those. But I would argue that now is the time that you definitely want to be broadening out exposure. I think the S&P 500 looks to be overvalued by any metric that you look at. And to sum up, essentially, how I would view it is by a guy named Roy Amara, who passed away, I think it was in 2007. But he came up with Amara's Law back in the 1960s. And essentially it says we tend to overestimate the effect of technology in the short run and underestimate the effect in the long run. And I think this is exactly where we are today. It's no doubt artificial intelligence is changing the world, and it's going to have massive implications in the next 5, 10, 15 years. But today, I think we are pricing things in the stock market like that technology is here right now, and it's as good as it's going to be in 5, 10 years from now. And to me, that's the concern. That's why you want to broaden out and be more diversified. I think having a financial advisor today is more important than ever to help you make decisions moving forward here. But I love the second part of this quote that in the long run, we underestimate the effect of technology. And I think that's so true too. The way our brains work, we think in a linear fashion. It's very hard for us to understand exponential growth. And the reality is that these technologies grow at an exponential rate. So even what our wildest dreams can imagine today, it's probably not even close to where we're actually going to be. And so there's a lot to be excited about in the future. I just think you need to be more cautious in this environment today. But you look at living standards in the United States and they just continue to grow. Not all the time, but over time. And I think that's important because this is about 175 years of history here. I mean, think of all the terrible things that happened over this period of time. And yet living standards over this period increased 20-fold. Being optimistic doesn't mean bad things aren't going to happen. We open the newspaper. I mean, there's a lot of stuff going on. Iran, there's a lot of stuff going on today. And yet the reality is that there's just so much more good going on than bad. And almost every year that good section, I'd argue, gets a little bit bigger while that negative section gets a little bit smaller. But I think especially with the advent of the smartphone, the amount of information we read about that much smaller negative section has grown almost exponentially that we miss out on so much of the good that's going on all around us. And so I think today more than ever, perspective really matters. And when you look at the way that our country is built here in the United States with private property rights, rule of law, and a functioning democracy, I mean, those three things in place make this a breeding ground for the entrepreneur. It's not always easy, and I think this is going to be a little bit of a tougher year for the market. The S&P 500, I think if you're broadening out, you'll actually outperform the S&P 500. But yet that entrepreneur is still alive and well in the United States. And I don't think that's going to change anytime soon. In fact, I think the rate of acceleration for that entrepreneur is going to pick up. And so there's a lot to be excited about. But I think it's also important to realize that artificial intelligence isn't new. It's been around since the 1950s. It's just getting better and better every year as chips are getting faster and faster and cheaper. But many companies that have been around a long time have built their entire company off of artificial intelligence. I mean, think about a company like Netflix. Netflix started back in the late 1990s. If I summed them up when they started, all they were was a machine learning company by direct mail. They'd send you those red envelopes with DVDs in the mail to your house. You'd watch the DVD, you'd put a star rating on it, you'd send it back. They'd put it in their algorithm. They'd say, okay, this guy likes this, she likes that, he likes that. Okay, we're going to send him this one. You know, I like that, I didn't like that. It goes back to the algorithm. Well, it wasn't until 2007 that they actually launched their online streaming platform. We couldn't stream anything online just before 2007. Kind of crazy to think about. But all of a sudden, they started getting millions of real-time feedback, users watching videos and shows. And by 2011, the higher-ups got together and they said, hey, we've been a TV and movie distributor for our entire existence. Our algorithms are now so good, we know exactly what people want. We need to start producing movies and TV shows. And so they went out into the market that year in 2012. And in 2012, a show was being touted around to all the major networks called House of Cards. Some of you have probably seen it. And House of Cards, every major TV network loved the idea of House of Cards. But they said, hey, where's your pilot episode? And House of Cards said, well, we didn't make a pilot. And they said, well, they kind of laughed at them. They said, well, that's how we do things here. We like the idea, but we got to make sure our audience likes it. Go do a pilot episode and come back. And in that year, there was 113 pilot episodes that were commissioned. Cost about $400 million to make those 113 episodes. Of those, only 35 of them made it to air. Of those, only 13 made it 2 seasons or more. So that means 1 in 9 pilot episodes made it 2 seasons or more. That's it. $400 million. Not very efficient, I'd say. That's how it had always been done. Well, here comes Netflix, never produced anything before, and says to House of Cards, hey, we'd love to pick you up. And if you've seen the show, Kevin Spacey was one of the stars on it. He was interviewed shortly after they picked up the show. And this is essentially what he said about Netflix. We believe in you. We've run our data, and it tells us that our audience would watch this series. We don't need you to do a pilot. How many episodes do you want to do? And sure enough, Netflix goes to House of Cards and they say, hey, how about we pay you $100 million up front for 2 seasons? And House of Cards said, yes, please. I mean, can you imagine all those TV producers in their ivory towers looking down saying, what are these guys thinking? I mean, they've never produced anything and they're going to put $100 million on this? Well, sure enough, the show came out in 2013. And if you look at 2013 at the bottom, Netflix was number 10 for Emmy nominations. Really impressive in their very first year ever producing anything. But as they started to produce more and more, very quickly, Netflix became either number 1 or 2 every single year for Emmy nominations. Why? Because they know exactly what people want to see. That's all they build. There's no wasted guessing. Their algorithms are that good, and that's all AI is. When you think about the productivity gains that we are going to see over the next 5, 10, 15 years across the board in industries, it's going to be dramatic. And I think that's going to benefit especially new entrepreneurs significantly. But with that, the stock market as well, with these massive productivity gains. So in the short term, I'd say yes. I'd be a little bit more cautious here. I think the market's overvalued. But when I look out over the longer term, there's a lot to be very excited about. So with that, I'll kind of end there. Andrew, if there's any questions, happy to take any questions, and we can go from there.
Yeah, Strider, thank you so much. As a reminder, if you have any questions, there is a Q&A button at the bottom of your screen that you can click on and type your questions, and we'll stick around for a minute or so and let those questions come in if anyone has any.
The Q&A or the chat, just the regular chat box. Both are open. You can use whichever you'd like. Another option is that Strider is just so good at what he does. He knocked it out of the park.
I
Everything.
I think he did. I think he did. Yeah. He did a great
You
job.
guys tried.
And yeah, I mean it's maybe the hype is too much currently, but long term we don't even know the ways that it's going to affect us positively, right? So
Yeah, I mean, it's an amazing time to be alive. You think about where healthcare is going over the next 5, 10 years. It's going to look completely different than the way it's done today. And the amount of healthcare that we're able to get is going to go through the roof. I mean, living standards in general, I think, are going to increase tremendously. And that in itself, I mean, that's what you want from an economy is growing living standards. And I think that's where we're headed. So there's a lot of fears I completely understand, and there will be people that lose their jobs, and they probably some areas they will never get another job, and it'll be tough. And that's the reality of going through these different technological changes, and the sad reality of a lot of it. But on net, when you look at the benefits that are gained from these new technologies, they far outweigh any of the negatives. And so for majority of population, even those that are impacted by job loss, they're going to see on the consumer side some pretty dramatic benefits, I think, as well.
yeah, well, I just think it used to be that everyone was in agriculture, right? And then
Sure.
kind of the industrial revolution, everyone worked in a factory. And this is just kind of that natural evolution of a lot, probably there's a bottom rung tier of jobs that AI will just knock out, and that frees up people to do something even more important or
Agreed. Yeah. And I think, and as I said, I think it's easier for those people that maybe they have an idea, but they're not willing to leave their employer today. And then they get knocked out and they lose their job. Well, now if they want to try and create something, it's cheaper than ever to try and do that. Maybe it doesn't work, and obviously majority of startups don't work, but I think there's going to be more than ever trying, which is a huge benefit to the economy long term and
yeah,
employment for that matter.
yeah, absolutely. Well, Tyler, I don't see any questions.
Yeah, no, it looks like you're good.
Yeah, so I think we'll wrap it up here. I want to thank Strider again and the team at First Trust for helping us put this on today. And if you do have any questions or if anything comes up, feel free to get in touch with myself or Tyler, and we can run questions to Strider or really anyone and help get your questions answered and use us as a resource. And we want to thank you for the time today and wish you all a great rest of your Wednesday. Thank you so much.
Thank
Take
you,
care,
everybody.
everyone.
Bye-bye.